The Federal Reserve is not cutting interest rates, but the board predicts a cut could come later this year if inflation falls. Michael George has the latest on today's meeting.
From the gas pump to the grocery store,
just trying to look for the best deal.
Americans continue to deal with years of high inflation.
It's really expensive out here.
That's why the Federal Reserve has decided to keep its benchmark interest rate at a 20-year high.
Inflation is still too high. Ongoing progress in bringing it down is not assured.
High rates continue to make borrowing more expensive. Used car loans are up to nearly 12%, and the average credit card interest rate is at a record high. The Fed has kept the benchmark unchanged since July, believing it would lead to lower prices. But in that time, inflation has barely budged, remaining above 3% the entire time. Policymakers want it at just 2%. The Federal Reserve sees changes on the horizon. In a new report, the board predicts the job market and economy will both slow down in the coming months, causing inflation to drop. If that happens, the Fed could start cutting interest rates.
If the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year.
In its economic projections, the Federal Reserve officials are thinking there are going to be 3/4 point drops this year. That could start as soon as the next meeting in May, but most people believe that it will begin at the June meeting.
But the Fed warns it will only cut rates if inflation comes down. Michael George, CBS News, New York.